Yes, we got it. So, yeah, I was just saying, I've been following you. I know you heard on Zoom, but yeah, I've been following you for a while. I think you put out some awesome content, some really valuable information that I think a lot of people don't talk about. I'm sure you see it all the time. The day traders, the Forex traders and things like that, that give out this crazy advice. And we get the same thing being more in the real estate world, people trying to oversell flipping and wholesaling, these crazy levered creative strategies. So I think it's awesome to see your account and other things you do kind of give more of the level-headed long-term approach to stuff. So thank you personally. I love it. So thank you for doing that.
Thanks. My pleasure. I do it because I think it's the right thing to do, and I believe it. So
yeah, same way. So for anybody who is not following you or doesn't even know your story, maybe they follow you, they don't know the whole thing. Can you give me like 1 to 3 minutes on who you are, your background, and how you got to where you are today?
Sure. So yeah, my name is Jeremy Schneider. I run the Instagram channel over at Personal Finance Club.
Mm-hmm.
Yeah, I guess going way back in college, I studied computer science, and
Okay.
I decided not to get a real job. I actually turned down a job from Microsoft as I was graduating college, and I started an internet company.
Mm-hmm.
And then I grew that for 12 years. And the first several years, I was like fledgling. I was living on credit cards. The business was a mess. I had no idea what I was doing. And the only credit I can really give myself in those early days was I was persistent, and I just
Mm-hmm.
didn't give up. And
Yeah.
you don't go out of business until you give up. And so I just kept trying. And then over the course of 10 years, it ended up growing and I got out of debt, and I started making revenue and hiring employees. And then in 2015, I sold the company for $5 million. We had never taken any outside funding. Actually, my mom was a co-owner at that point.
It's
And
awesome.
so, yeah, so I owned most of it and she owned the rest. And then we kind of split the money, pay taxes. And so I ended
Mm-hmm.
up with about $2 million after taxes. And then I basically became an index fund investor where
Sure.
I buy and hold index funds. And I also own some investment real estate as well.
Mm-hmm.
And so I basically, after working for the company that acquired us for 2 years, I quit in 2017. And that was actually 3 years ago today, I think. I think on the dot, I quit 3 years ago.
Oh, there we go. Good timing.
Yeah, I think it was like April 6th of 2017 or whatever.
Okay, nice.
And then, so I haven't had a job in 3 years, and I now teach people about personal finance and investing, which is kind of my passion. And so, the beginning of my wealth definitely came from selling my company, but I was also investing all along. I was also living below my means all along. And then when I sold, then became a more, diligent investor to make sure I really understood what I was doing and didn't, squander my money.
I love that. I think the biggest thing you touched on, and one quick question first, and I think I already know the answer, but where was your company based throughout the early years in the whole process? And
So
where
I'm
were you?
from Michigan.
Okay.
And so I grew up in Michigan, and I went to the University of Michigan, started the company when I was finishing college at Michigan. And then when I was about 30, I moved to San Diego, started hiring people, and then grew the business here. And we were just 7 employees when we got acquired.
Gotcha. So I think that's so important because I'm from New York. I live in Brooklyn, and even Long Island is very expensive. And those high cost of living areas, everybody likes to have the opinion of, I can't do it here because it's too expensive. And I think you hit the nail on the head, and that live below your means is such an important factor to be able to launch anything or do anything, especially if you want to invest or do other things. And it's just a strange coincidence. We were talking about this the other day. Too many people, I think, over leverage their housing by going to the max of what their income allows. So if they make $50,000 a year, they qualify for $300,000 for a mortgage, and they go and
Yeah.
take $300,000 in a mortgage for a house that costs, if it's an FHA, it might be, 330,000 or 360,000, or maybe it's more, whatever it is, but they maximize what their payment is instead of saying, all right, I can afford 300,000, but I don't want all my money just going into my house. I'm going to take 150 or 200. And I think
Yeah.
that's a mindset that's not really prevalent in this country or even across the world. It's the same thing for rent too, right? Most of our properties and our tenants have to qualify for 3 times the monthly rent in what their income is per month. So if the rent is $800, they have to make $2,400 per month. It's the same as, or you do 36 times, it's the same thing.
Right.
But most of your tenants are right at that threshold. They're either like just over, a little bit over, or a little bit under. You very rarely have somebody that's, 4 times or 5 times what it is, which is what I do. I'm way below. And that's why
Right.
I'm able to continue to invest. So I think it's huge to hear that that's what you did. And I think you actually had one post of like lived in somebody else's house, like in their garage for a long time. And only recently you were getting your own place or something like that. Is that right?
Yeah. I mean, the garage thing is a little bit of a joke. It was a garage and it was converted to a
Yeah, of course.
perfectly nice apartment unit. But yeah, for almost 6 years, I lived in a 1-bedroom, and I only moved like 2 months ago, like kind of
Yeah.
right before I got quarantined in my nice new place you see behind me. But when I was growing my company, I was running a company that had about $1 million a year in revenue, and I was living. I had a roommate. Lived in a 2-bedroom, 1 bath. I was paying $700 a month in rent in San Diego, which is like crazy cheap. I was driving a '99 Ford Explorer. I eventually moved to my own 1-bedroom, but it's still super cheap rent. It was like my friend's converted garage. I lived there for 6 years, including like 4 years after I sold the company and I became a millionaire. And and what you just described is like the mantra of the middle class, which is just live right up to your means, right? Spend every dollar you can. And whether it's renting or buying, people just spend until they have no money left. And then when they wake up and they're 50 or 60 and they own nothing or they have no investments other than the house that they live in, they wonder where they went wrong. And so I think that living below your means, I have 2 rules of investing. Number 1 is live below your means. And number 2 is invest early and often. So if you make $4,000 a month and you spend $4,000, you'll be broke. But if you make $2,400 and you spend $2,000, that $400 a month of investing can make you a millionaire over a career. And that's just such a critical, important factor that so many Americans miss because we live in like land of consumerism.
Yeah. And I think that's why you see so often like, X celebrity, X athlete made, $50 million in their career, $100 million. And then you hear they go bankrupt and you're like, how the hell do you make $100 million and go bankrupt? You could live on cash for the rest of your life and not make another nickel and live a great lifestyle. But it's because people live above their means or at their means. And then they also try to overcomplicate investing, which I think you do a very good job of undercomplicating investing. So
I'd say appropriately simplifying.
Yeah, appropriately simplifying. There we go. You've clearly had time to come up with the right terms, so that's good. But this whole series that I've been doing is, kind of centered around what's been going on and how it's affecting different people. So I do want to get back to a little bit of your story, but I do want to stay centered on, kind of the purpose of all this. I know you've been pretty active and open about how everything has affected you from the financial standpoint, but can you talk a little bit about the past, call it even 8 weeks, because the open market got hit a little bit earlier than a lot of the real estate stuff. Can you talk a little bit about like what it's been like for you, how, when you saw things happening, what you've been doing, if anything, how you've been staying sane and, sticking to your track if you have, and all that good stuff.
Sure. I started Personal Finance Club in the beginning of 2019. And then for my whole life before that, basically, I've been a buy and hold investor, which means when I buy something, I plan to hold it for decades. And so I've always said, live below your means, invest early and often, buy and hold, and don't sell anything until you retire. And so, in whatever it was, late February, early March, the market dropped by about 30%. And I did nothing. And I plan to do nothing for decades. And so, numbers on a website look different when I log in. I had a few days where I lost $100,000 in a day or whatever. Someone just said, I'm so bored. Yeah, I know. It's a very boring strategy because I do nothing. And I get this question a lot. They're like, well, what do? You're down 30%. I was like, I do nothing. Who cares? And someone's like, well, what if you're for me, who cares? Because I'm just relatively young. I've got, many decades of life ahead of me. So it's going to go down 30%. It's going to go up 30%. Who cares? Because I'm not selling for many decades, if ever. But someone said, okay, well, what do you do if you are at retirement and then the market crashes? And so let me tell you exactly what you do. So let's say you're an old person, you're 65 years old on a dot, and it's March 1st, 2020, and
Mhm.
then the market crashes and your whole retirement's ruined. And let's say you've done a relatively good job of investing. You have $1 million saved up for retirement, which like isn't, it sounds like a lot of money, but if you're 65, you basically need about $1 million to survive.
Right.
So the $1 million, the market drops by 30%. So what do? You do nothing. Your $1 million portfolio is now worth at the moment $700,000, but even at 65, you still have 30 years of life to plan for ahead. You can live to 95 easily at the
Mhm.
age of 65 these days. And so you're temporarily down to 700, and then you just sell what you need each year to live on. So maybe you sell 50,000 a year to live on. And then in 3 years, your 700 is back to 1.1 million and you're fine. It's no big
Mhm.
deal. And so I think there's just this concept of the market crash, and you turn on the news and everything's in the red and the bells are going off and people have their hair on fire and they're running around. And if you just think long-term and realize there's short-term volatility, but long-term, the market's going to come back, then it's no big deal. And so I'm sleeping like a baby because I've made 0 trades in 2020. I own everything. At the beginning of the year, I owned a bunch of global stock, and I now own a bunch of global stock. What people are willing to pay for it in a given day fluctuates, but I don't care because I'm not
Mhm.
selling.
Yeah.
And I sleep like a baby. And the people who are not sleeping like a baby are the people who are trying to time the market. They're trying to pick and choose stocks, or they're getting out and they're in this washing machine of like selling and trading and getting thrashed around. And when they come out the other end and the market finally recovers, they're going to be worse off because they've been getting hurt by all their trades, where I've just guaranteed myself my fair share of the future market growth by never selling anything.
Yeah, I love that so much. I think one of the reasons I really got turned on to is my boss where I work, one of the owners. He recommended a book called Quitting Like a Millionaire. I don't know, you've probably heard of it or read it, but they have some really good strategies and just like a really good mindset around a lot of the stuff you talk about. And they actually talk about things like cash reserves and stuff like that. And I don't know if that's anything you employ either. But I think, yeah, it's just like the same mantra that I've been hearing now for a while, and it's just really resonated really well. And it's just like one of those things that for me, as I only got into this, I'm 28, so 4 years ago. So 24, still fresh out of school, um, you know 2 years give or take, still very naive. And it was like, as I started getting introduced to this stuff and being in it every day, it was just like, if you're going to buy and hold and go long, you've got to have capital to do it. And the way to build up capital is to not spend money. And in that book, and if nobody's read it, I highly recommend go reading it, because there's one chart in it that for me was totally worth it. It was like the percentage of your income that you save per year versus how quickly you can afford to retire. And it was the more percentage you save, the quicker you can retire. And
Yeah.
obviously, if the chart goes to 100%, if you save 100%, that means you can live on nothing. Obviously, that doesn't make sense, right? That's
Yeah.
not the point. But if you're in between saving 0% and saving 50% of your income, you can see how much quicker you can retire just based on whatever you
Yeah.
make. There's no
It's a
even
massive
dollars
difference.
involved. So yeah,
I,
it
I
was
had that
huge.
exact chart posted on. I've done the math myself and posted that exact chart on my Instagram. And yeah, and if you're saving like 5%, it's like 60 years. You
Mhm.
will be able to. If you save 0%, then you won't be able to retire. You'll have no
Yep.
money. If you save 5%, it's like 60 years. And so if you're 20 and you work your whole life and then you're 80, you'll be able to retire. But that's pretty. It's like a pretty rough career. But if
Mhm.
you save like 45%, it's like 13 years or something. It's like crazy. And so if you can literally save like half of your income, which is a dramatic step, no
Yeah.
doubt. So if you're making $80,000 a year and saving 40,000 a year, that means every month you're just taking 3,500 a month and just slamming it into retirement. It's like
Mhm.
massive checks every month. Like that's a dramatic step take. But that means if you start that at 25, when you're 37, which is 2 years younger than me, you can retire. Like it's an insane thing. And that's assuming a certain level of growth, which is like 7%, which is very reasonable. And it's assuming you don't start spending more after you retire and stuff like that. But
Mhm.
you're in a dramatically different situation than if you're saving 5% or less, and then you're 80 and you're pushing carts in the grocery store because you can't afford to eat food. It's pretty ugly.
No, I think that's great. And it's something we've been talking a lot right now, where we're actually in the process of selling 2 properties. And we're actually in the process of buying another property. Both started before all this occurred. So they started when the world looked fine. Everything was good. It's been up on the rise. And, we were concerned about something happening, like anybody who's investing, but no indications that something was going to happen. Then all of a sudden you wake up and it was like a light switch, everything changed. And now it's those conversations of the one deal we're buying, we're talking, having serious conversations about, we have personal capital at risk that if we walk away from the deal, we just flat out lose. We have certain deposits up and things like that. And the conversation is it the right thing to walk away and lose money, but our investors don't get put into a bad deal and our own money doesn't get put into a bad deal? Or do we continue to do it? And then the same conversation is being had where one of the properties we're selling, they've asked for a significant price reduction, more than 10%. And it's the same conversation of, what do we do? And both of those properties have very long time horizons on them because we have debt for the next, on the deal we're selling, we have at least 4.5 years, closer to 5 years left on that loan. And the one we're buying has about 7 or 8 years left on it. And it's the conversation of making sure we don't get too caught up in the day-to-day valuations and pricing and the impacts of the properties versus what is going to happen over the next, year, 2 years, 5 years, 7 years, whatever it may be. And how do we think, the market is going to react and how are these properties going to react? And can we sustain through this period? Because, right now everyone wants to talk about what is the pricing of these properties, and the pricing's just got slashed ridiculously because there's not a lot of capital going around. So, if nobody wants to buy your property, it doesn't matter how great it is, your property is worthless. If all of a sudden there was literally no, if for whatever reason nobody could buy a property and you wanted to sell tomorrow, nobody can give you $1, but they'll take it from you. So it's worthless. But it's really not, obviously, because there is value to it once things kind of stabilize. So it's trying to balance that, short term of, hey, what is the short-term impact and is the long-term benefit outweigh that and not? So I think it's really interesting to hear kind of the parallels between the two of, the stock market, of you not selling, not overreacting to anything going on now, seeing the longer term, and, us in the same way, but slightly different because we are in the process of making that decision of whether to, sell or buy, because our business plans don't allow us to hold forever, unfortunately.
What types of properties are they and where are they located?
So we deal almost exclusively in multifamily apartments. So 80, 100, 300 unit properties. One property the property we're buying is in Jacksonville, Florida. One of the ones we're selling is in Jacksonville, Florida. And one of the ones we're selling is in Greenville, South Carolina. So we're based out of New York, our headquarters, but where we buy is in the Southeast and Midwest. So we look for cities where people are moving to. There's job growth, population growth. Before this, good unemployment or trending unemployment. So, good job diversity, which has been hugely crucial in this time because, if you're overly reliant on the retail sector, you just got smoked. If you're overly reliant on travel, you just got smoked. Look at hospitality, look at, hotels, stuff like that. So that was always something that was important to us. But yeah, we're multifamily in the Southeast and the Midwest.
Yeah. I mean, it's weird. The world did turn off like a light switch. And I think nobody knows, the word unprecedented has been thrown around a lot. And there have been lots of unprecedented times. Like most recently, 2008 was unprecedented when banks were failing. But, turning off a global economy like a light switch, I don't think anyone really realized it was possible, like maybe short of like a nuclear holocaust or something like. And so now that it's happened, the big question is like, can it be turned back on like a light switch? Everyone's kind of like sheltering in place. And I think a lot of money is sheltering in place. Like you've on the buy side and the sell side, you've experienced that where you're like, everyone's like, but then, when this is over, and this will be over, I trust the experts. This is a very serious medical issue. I'm staying at home. I'm washing my hands. I'm doing the whole thing. But even the experts say like, this is not going to end the world. It's not going to kill all of us. We're doing the best we can do to protect as many lives as we can in combination with not trying to destroy the economy. And so the question is like, in the upcoming weeks or months or whatever it is, when the experts like, okay, we officially are in the clear, whatever the virus is to a point where we have herd immunity or we have the vaccines or whatever, does it go back on? And no one knows because there are some businesses that are going to be irreversibly hurt, like maybe a restaurant couldn't pay their rent or whatever. There are going to be some changes in human behaviors. Maybe people are more scared to go out to restaurants, or there may be, maybe businesses are less likely to higher on leverage or whatever the case may be. But yeah, I do think that the economy will recover, but it's just like we talked about 2008, just like we talked about the dot-com crash, just like we talked about 1987. This is going to be another one of those periods of a couple of years where things are a little weird, but it will come back. The world will turn back on, and I think the people who stay the course and keep investing and make wise decisions without being panicky are going to prosper during this time.
Yeah, I think that's I agree with a lot of what you just said. And I think about 2 or 3 weeks ago, I thought it was going to be a much quicker recovery. I think now it is going to take a little bit longer. And I don't think we're going to quite hit back to where we were. I think, if you went by unemployment, let's say we were at 3% before this started, I think we'll be 4.5 probably is where we'll end up being. And slowly over time, that'll come back down. Just because, like you said, a lot of stuff, it almost feels like a halt. It's not like things were irreparably lost. The one place I do see it, I was talking with Mike Ketchin the other night on the series, and he owns some properties up in the New England area, so New Hampshire. And one of his, he's a mixed use building with a retail component, and one of the bar owners he knows very well, is friends with, and he said in that area, like 75% of bars and restaurants, he has a coalition, knows them all. They're just going to go out of business. And my question to him was, one, that sucks and that's not good. But if you've got all these spaces built to suit restaurants, bars, and things like that, isn't it very easy for somebody with a little capital to just step in place into that area and start up a new bar that looks very similar, might even hire some of the same bartenders and things like that because they know the area well, but they change the name or they change the ownership, or it might even be the new ownership with the new name, but it's the same process once it comes in. So it's like, for me, I do think there's going to be a lot of businesses that shut down and go out of business and things like that. But I do see a lot of areas where people are just going to step right back into it. But I think it's really going to depend on when does the lockdown end and how quickly are people willing to go back to, a packed bar in downtown Manhattan, like I typically go to. Are people going to freak out? Like, I know for me personally, I'm pretty okay. Like, I still go to the supermarket. I don't really have a lot of issues, but like, I was talking with my mom earlier. She's like, I'm getting all my groceries delivered because I don't want to go out and interact with anyone. And she's in Florida. I'm in New York. So very different. So it's like, I sometimes, try to take a step back and be like, okay, how is the rest of the community and the country going to react to this? Even though I tend to be a little bit more optimistic and things like that. So, I do see that aspect of it. How has it been? Because I am curious. I like talking to people in different areas. I'm in New York. I only personally experience in New York. I get a little bit of flavors from where our properties are of how things have been from a local level. What's it been like in San Diego and whatever other areas you've been in?
I've been in San Diego since this hit.
Mm-hmm.
Haven't traveled. I think not traveling is wise. I think the less we can just be mixing people is the better right now. But yeah, it's very weird, like all the beaches are closed, all the parks are closed. Restaurants are takeout only. Like going to I've been shopping at Costco, which is like a very creepy experience where they're like, there's masks and lines and they like let people in slowly. And so it's definitely weird. It's scary. But when I look at, why this is happening, it's not because there are bodies lined in the streets right now. It's not like we're under attack from a foreign nuclear power or something. It's like most of the bad stuff right now, not all, but most of it is just preventative. Like, we're trying to help, like we're doing the right thing as a global people to try to prevent deaths. And so while it is scary, I remind myself it's for the best of reasons. And, I am also one of the fortunate ones where I get to like stay safe at home. That's like this crisis for me is like a lot of like Netflix in front of my fireplace over here, and I'm very thankful to, of course, like the doctors and nurses and the delivery drivers and the garbage truck drivers and the postal people and, the people who are, doing, they're ones who kind of need to keep working to make both save lives and make the world keep going around. And I'm thankful to them and hopeful that they're safe and everything. So it's definitely weird, but I think mostly for the right reasons.
Yeah, I think It was definitely, so I live in Brooklyn, but I actually left Brooklyn to come all the way out East Long Island, like an hour and a half. My mom has a place out here. So I kind of got out of the city because I just didn't want to be in the area. And I have a roommate as well, living below my means. And we just didn't want to be cooped up together. So I was like, I'll get out of here. And I've been talking to him through this process. He said Brooklyn is, you know, very similar, like a ghost town. And I was just looking through the comments, and someone said they waited 3 hours for a pizza, and he told me the same thing. He was like, I'll order food on like Grubhub or Seamless or all these different apps, and it'll take like an hour and a half, 2 hours, 2.5 hours, where normally it's like you can get food in 20 minutes sometimes. A lot of stuff is
Yeah.
like 30, 45 minutes, whatever. And he said like now it's crazy impossible. And he said like just to get into Whole Foods, wasn't great. Like you said, lines to get in. And it hasn't been like that out here. I was actually shocked. I went to the grocery store for the first time on like a Saturday in the afternoon on like a decent day. And I was like, God, I really hope it's not like crazy packed or whatever. And I walked in and it was surprisingly calm and fairly normal, which I was very thankful for.
Yeah.
Like it wasn't anything crazy. Like, people were masked, and it was funny. Some people would do like dances to, like definitely stay away from you. Like they're very cognizant of like, would like shuffle quick to like get out of the way, or like if you came a little bit too close for what they were comfortable for war, like off their shoulder, they would like startle and like move the other way. So I find it funny because you try to stay 6 feet, but if you pass someone at 5 feet, it's not. I don't. What are you gonna do?
Yeah.
But that's just me. Right, wrong, or indifferent. That's just who I am. But yeah, I've heard it's in the city and stuff like that, it's gotten pretty crazy. But out on Long Island, and apparently in the last like day or two, Long Island's like the new area for like some of the highest number of confirmed cases. So it's apparently getting worse. But I haven't really seen any crazy reaction from people. But just like you, I haven't really gone out. I've stayed put. I've only gone out to go grocery shopping, and I went to a park down by the water once just to walk around on a nice day because it's still in the 40s and 50s most days here. So no, I think that's really interesting. Is there anything, that you're thinking about doing or adjusting, or anything you're taking away from this period in time? Obviously you went through the '08 crash as well. Personally, I don't know how much you were investing at the time. Is there any big difference from that one to this one that has shifted some of your mindset or thinking or the way you're talking about things as you're going through this, or not really?
Not really. I mean, I invest with the assumption that there's going to be crashes, right? Market
Mm-hmm.
crashes that I call short-term volatility. And so this was weird. It was
Mm-hmm.
very weird. Like I was watching TV one day when like the NBA was canceled and March Madness was canceled. I was like watching ESPN and I was just like, what? Like, what is
Yeah.
going on? Like just and the world is canceled. And then, then you watch the market over the next 3 days just dropping like, there's this thing called the circuit breaker in the stock market where if the market drops more than 7% in the same day, they halt trading for 15 minutes. They just basically like freeze trading just
Mm-hmm.
so like people can be like, catch their breath and be like, what's going on, to hopefully calm the
Mm-hmm.
market. And I had no memory of ever seeing the circuit breaker hit. I think maybe it was hit in 2008, but I was young. I was younger then. Like I wasn't really as aware.
Mm-hmm.
And then there's like a week where like every single day is getting hit. It's just like if the circuit breaker wasn't hit, that was a weird day. And it's like just so bizarre to have just like this crazy volatility just because it happened so fast.
Mm-hmm.
But at the end of the day, like the market right now, the market was up 7% yesterday, and then today it was zero. It was exactly flat.
Yeah.
And so the market today is where it was in like January of 2019.
Mm-hmm.
We're back like 14 months. And so in terms of like financial crisis is like right now, it's not that big of a deal. And for sure, the question is, what does the future hold? And that's why we're seeing this volatility, because the market doesn't like uncertainty because we don't know what's going to happen.
Mm-hmm.
But my plan has always been to plan for a volatility. And so I'm not doing anything different. I plan to buy and hold index funds, invest early and often, live below my means for the next 50 years. The only thing that I would maybe suggest to people is if your income is impacted or you suspect it might be impacted, is to basically pause everything, like pay the minimums on all your debt, stop investing and pause everything until you have a full emergency fund.
Mm.
And a full emergency fund, I would say, is probably 6 months of income or 6 months of expenses. And the reason is, we don't know how long this is going to last. And so I wouldn't want you to be investing right now if you didn't have that cash buffer. And if you come out of it, your job is secure, the world turns back on, then it's not going to be the end of the world to go invest that money 6 months from now. Like I said, even today, we're back where we were, in January of last year. And so investing now or 6 months from now isn't that big of a deal if you're thinking about 30 years in the future. But you just don't want to be in a position where you become broke, cash poor, you're on credit cards, overdraft, stuff like that. And so it's definitely weird. Every day I look outside and just think of how weird of a time it is. But financially, I'm doing the same thing. And the reason is because I don't believe it's reliably possible to jump in and out of the market. It happens sometimes if you get lucky, but I don't know. No one knows what's going to happen over the next week or month, and everyone has a theory. And so if you're trying to jump into the market, you're trying to make trades based on what the market is doing, you're more likely to hurt yourself than help yourself. And so that's why I do nothing.
Do you ever consider, just curiously, taking 1 or 2% just to play around with as hey, this is going to be just a bit of fun, whether it's in the market or in other things, just to see hey, maybe I hit that, that unicorn or something like that. And, I can afford to, hey, I'm going to take 1%, and this 1% is in my head gone. It's in the trash, it's whatever. But on the off chance I can do something special with it, and, things I've seen, I can play with it a little bit and maybe I can accelerate some stuff. Is that anything you ever think about? Or no?
It is actually, and on my page, I recommend that exact thing. I call it the 90-10 rule, which is with 90% of your, of your equity investments, like your stocks, bonds, index funds, buy and hold index funds. So I take the vast majority, 90%, buy and hold index funds, don't sell anything until you retire. Then with 10%, go nuts, whatever. And because I think a lot of people have this pressure valve they need released, which is, logically they know index funds are most likely to maximize their wealth, but come on, I think we're on a Zoom meeting right now, and I just read how Zoom is valued at $34 billion, more than Ford and Chrysler, really this kind of young messaging app of which there are, or video messaging app of which there are a bunch of others is worth more than Ford. And so go trade, short sell Zoom, or go buy Beyond Meat or do Bitcoin, and I think it does two things. One, it lets you see if you're really smarter than the market, which you're probably not, but it is buying you a lotto ticket, as I look at. So maybe you do hit it big, and that would be great. And it gives you the opportunity to measure them against each other. So if you're doing 90-10, a year later, did your 90 grow faster? Did your 10 grow faster, proportionally speaking?
Yeah, no, I think that's interesting. It was something I always thought about doing funds, but I was just I'm just going to pick companies I like. So right now I don't own any funds. I'm God damn it, that's so dumb. So I luckily, right before this started, I had some cash sitting on the sidelines that I was waiting to deploy both into the market and a couple of the properties we were buying. And then this happened. I was oh, this is perfect, because I know if I go, I'm very similar. Every stock that I buy, I'm going 30 years. I didn't buy anything. So I'm very fortunate and I love it. But when I really like Tesla as a company, so I bought a bunch, 2 years ago when it was in the 400 range. And then when it dropped down, I cost average down super heavy. I was they're going to come out of it, whatever. And then it obviously ripped up to 900. And I was I'm a genius. And I was so close to selling it. And I was it doesn't matter, because I know in 30 years, even if I sell it and buy back, in 30 years, if I continue to want to buy this company or a fund, it's not going to matter. It may be in the short term, I get some joy out of it, or benefit if I do it right and I do time it right. But I know in the long term, in 30 years, I'm going to look back and say it's irrelevant. And if I made a mistake, I'm going to kick myself. So I didn't sell it. I wish I did now, but it is what it is. But it's definitely something that I've always looked at where I'm it's interesting you said that. I looked and I compared it to the market, and just because I did so heavily cost average down on that, I did outperform the market over the last 18 months, solely based on luck. completely luck. But I looked down, I was like, that's dumb, because if it had done the opposite, I'd be kicking myself for not being in it. So like, that's something I'm looking at heavily to get involved in. And, the stuff you've been talking about has been a big part of that. So I appreciate that. Trying to think if there's anything else.
Yeah, I think everyone has a story like that where they're like, oh man, like I own this, or I have a terrible one, which is basically the one main stock I own is the stock of the company that bought my company. And I used to own a lot of it, and I bought it at $12 a share. And then I sold 80% of it at $24 a share. So I doubled my money. I made like $400,000. I was like, I beat the market because it definitely doubled faster than the market did. And I was like, all right, I'm going to take my chips off the table and go back to index funds, take my double. That stock a few weeks ago before this hit, where I hit $150 a share.
Oh
so
my God.
It was up, 13x or whatever. And so that little, if I had just held that and sold it at the exact peak, which of course you can never know when that is ahead of time, it would cost me like almost $3 million or something like that. Just it's just an insane number. But that said, like if I had gone from 12 to 2 and I lost 90% of my money and I just burned $400,000, like I would have felt like an idiot, right? And so you don't know ahead of time. So everyone has a story, and stocks are so tempting because looking backwards, it all seems so obvious. Of course, Tesla was too high. Of course, it dropped back down. Of course, Beyond Meat does. Of course, this. Of course, this. But then looking forwards, it's not so obvious, is it? Is Tesla going to go up again? Is Beyond Meat going to do the thing? And so when you're marching forward through time and looking into the black void of the future, you can't know what's going to happen. And so because you think you can, because you look backwards and it seems obvious, people kind of lull themselves into this belief that they can beat the market, or they should be picking and choosing stocks. But the more you learn, the more you read, the more studies you see, and the more you understand how the market works and how stocks are efficiently priced, that's just not true. And generally speaking, on average, the more you trade, the more you pick individual stocks, the more it will hurt you. You're just exposing yourself to more volatility of individual stocks without more expectation of growth. So don't beat yourself up over not selling Tesla at the exact moment. You can't know that for sure.
I'm really not. It's only like 2% of me that's kicking myself. But no, I think it's interesting because it's like two things that I think recently is that, like, one, did you see that company the Chinese version of Starbucks? I forget the name. Was it like Lucky Coffee or something like that? That just lost like 80% of its market cap because they've been fudging numbers for 3 years.
Oh, no, I didn't see that story. Huh.
Yeah. I forget what it's called, but if you type in like China Starbucks loses, crap ton of money, that's what come up. So it's like, you may think you've been riding the high and beating the market forever. And then you find out, some guy's been lying about financials for 3 years, and all of a sudden you lose 80%. That stuff happens. And the other thing too, is like, I'm worried too. Like, I am falling victim to this a lot right now. It's like, I'm looking at companies. I'm like, oh, what should I, like, I've got this cash I'm waiting to buy. And I'm like, one, what day do I do it? And I'm trying to think, I'm like, 30 years, it won't matter. It won't matter. It won't matter. And then two, it's like, I look at companies, I'm like, oh, like United Airlines or Norwegian Cruise Line, or this company was, 5 times what it is today 3 months ago. If I buy it today, in 5 years, it'll be back up to where it is. But the reality is it's not necessarily true, because a lot of these companies, especially all the airlines and maybe not the cruise lines, but they're getting bailed out. Their business model is going to change, their revenue, and they're going to, they're saying they might have to give up equity in the company, the loans they're taking out, their different metrics that they're going to have on their company. Even if they get back to all the business they were generating at the same numbers, they're probably going to have additional costs and additional penalties that they didn't have before. So it's not like, hey, they're just going to get back to where they were when everybody starts flying again. And I think people need to think about that just because just because Tesla was at $930 doesn't mean it's going to go from things at like 500 now or something. It's not going to go from 500 to 900 necessarily, because things are going to change in this world. Who knows what them changing to manufacturing mass is going to do for their business in 12 months. It could amplify it. It could make it worse. So that's definitely like a trap I find myself falling into, of like, oh, like everything's down, so let me find the companies I think are going to bounce back really quickly and stuff like that. And I think if you think about it logically, there's just the wrong mindset to go into it, at least for the bulk of your money. Like you said, if you want to put 10% on red, go for it.
So let me tell you a story about stock. So when you buy a stock like a Tesla or a Cruise, you don't need to answer the question, is the stock likely to go up? Most stocks are likely to go up because they're
Yes.
profitable companies, they're paying out dividends. The question you need to answer is the stock going to go up faster than the sum total of the rest of the market on average? Because if the answer is no, then when you buy Tesla, you're effectively not buying everything else. And so like, let's use the cruise ship example. Like, let's say you can buy Norwegian. You're not buying Apple, or you're not buying Microsoft, you're not buying ExxonMobil, you're not buying Philip Morris, you're not buying every other stock. And so is it going to go up? Going to go up? Probably, but is it going to go up faster than everything else? Probably not. And the reason it's a tough question to answer is because the question of does it go up faster than everything else is a zero-sum game, which means the average of every stock in the market is the market, right? And so if the market gets 10% in a year and you buy a stock that goes up by 8%, you didn't make 8%, you really lost 2% to the market. And the sum total of that delta between what the market makes and what individual stocks makes, that sum total of all the stocks combined is zero, because for every stock that beats the market by 2%, one has to lose the market by 2% such that the average stays at the market, right? And so when you buy a stock and you say, oh, I did well, I made 8% or whatever it is, you might have actually lost money based on losing the market. And when you're picking and choosing stock, it's like this teeter-totter where one goes up, one goes down, and you're trying to be on like the winning side teeter-totter, but it's impossible to. And every single change you make is just an opportunity to like lose more because you're like missing out. So
yeah, I think it's really interesting because what I took away from what you were just saying, and it was really great to hear, because as you started talking, I'm really trying to drive into people's head in like the real estate space that not every deal is the same and not every 15% projected return is the same, because the risk could be very different. And I think what you were just saying is very similar to what I'm saying, is that the risk associated with one stock is probably and almost always is substantially higher than a blend of 500 companies or 1,000 companies or the whole index, whatever it is, because you're so at risk of, even if you're just in one industry, even if you buy an ETF for, a tech sector or the car sector, whatever it is, if all of a sudden the laws change overnight, it's not something the company can control. They get slaughtered. If tariffs go through the roof, for cars manufactured overseas, your company could get destroyed. So, even if you can beat it, how do you value the, and this isn't necessarily, it's more rhetorical, but how do you value the risk associated with that? And then how do you weigh it against that? Because that's something I've been trying to communicate with people as they're looking at real estate. It's okay. It's not just about what can this make you, because you're skipping over the first step, which is capital preservation, right? You've made all this money. Now you're doing something with it. The number one goal is not to lose it. Then it's valuing, what can this make me? And I don't know about you and your experience when you've interacted with people on the market side and the equity side of thing, but definitely in the real estate side of things, so many people gloss right over that. I mean, when we talk with investors for our own deals, 80% of them just flip right to the returns page. They don't care about the market. They don't care about where in the market it is. They don't care about the leverage of the debt, stuff like that. What they do a lot of times, it's so funny. They flip to the returns. If it's not what they're expecting, then a lot of times they'll use the other things they just glossed over to say why they don't want to do it, which is fine, right? If that's what you want to do, that's fantastic. Can do whatever you want. But for me, it should be, hey, do these boxes check off what I'm looking for, come closer, whatever, however you want to do it. And then is the return where, I think it needs to be, or it can be. And I think it definitely, in my space, it gets overlooked. I'm curious if it's the same for you.
Yeah, that's a great point, which is if you're willing to accept greater risk, you should be getting a greater expected return.
For sure.
And when you buy an individual stock, you're accepting greater risk without the expectation of a greater return. And so sometimes very, very new investors ask me, how do I get 10% with no risk? And the answer is you don't. That doesn't exist. There's no such thing. If you want no risk, you can put it into an FDIC insured checking account. You can get yourself 0.5%, or whatever. If you want 10%, you have to be willing to accept the volatility of the market. But when you buy an individual stock, your expected growth is still kind of the same as the total market, because that stock is efficiently priced based on the market. but you're not getting more further growth, right? And so, like you said, with real estate, same thing. People they just want the biggest return number, but if you only need to get that, you should only be willing to go after that return if you understand the risk. Because yeah, there's maybe some properties out with a cap rate of 20%, but like maybe the tenant is a crackhead meth dealer and it's about to go bankrupt, and that money's going to stop flowing pretty soon. So it's like a very risky 20%, you know. And so you want to understand both of those pieces of it, where you want the greatest return possible, but understand the risk involved as well.
No, 100%. I think there's even just like personal risk and like personal comfort level that comes into it. You know, we talk a lot about like, because we do all of our stuff out of state. So a lot of people want to know like, how can I do it in different areas? Because that's like the hot thing now, and, you know, investing online and stuff like that. You know, how can I invest out of state, out of area, whatever? Because everybody believes they can't do it there, so they're going to go somewhere else, which is true to a certain degree in some areas, but it also depends what you're looking for. But like, we choose markets for different reasons. And one of the reasons we look at certain cities is we look very hard at the size of the population. We only want, except for a couple exceptions, we want 1 million people or more in the MSA, which is like the metropolitan statistical area, which is basically like the city and the surrounding suburbs, if you think about it. So we want those areas because we feel, one, travel significantly easier, and two, there's a much higher demand and significantly more resources available in that area. And there's also significantly more capital interested in that. So if you're in a market like this, and if you own something in the middle of West Virginia or the middle of Nebraska in a town of, 10,000 people, there's not a lot of buyers that are buying that property, and very, very high chance and a very risky chance that that person, doesn't have the capital or isn't looking to buy right now. But if you own something in downtown Manhattan, almost in any market, no matter what's going on, maybe not the price you're looking for, but there's probably an ask for that seat. So that's where like the risk reward comes in. And a lot of people don't also think about it that way. So I think it's really interesting from that regard. But I think that's a great place to wrap it up. We've been going on, almost 50 minutes now. So, Jeremy, thanks so much for doing this. This was awesome. I definitely picked up a little things personally from you. I'm sure anybody listening pick some stuff up. Besides Instagram, is there any other place people can get a hold of you, learn some more stuff?
Yeah, most of the magic happens here on Instagram. I also have a website, personalfinanceclub.com, a very young YouTube channel at Personal Finance Club. Easy to find.
There you go. Awesome. Guys, anybody watching, we are recording this on Zoom. I am going to try to have it up tonight. I'll provide a link in mine. I'll send it to Jeremy so he can share it. I'm also going to provide it to him so he may put it on his own stuff. So if you guys, came in for the beginning or the end, you want to see the whole thing back, it will be up by tomorrow at the very least. So be sure to go check it out. But yeah, thanks again for coming on, bud.
Yeah. Thanks, Chris. Appreciate it. Have a good one.
Yep. Have a good night, everyone.